Oh dear, welcome back to another thrilling instalment of Let's Watch Our Money Disappear, the Forex edition. In case you're curious, we're still on the quest to find the holy grail of trading strategies and indicators. So if you want to know how it's worked out so far, well, it's good 0 and bad 3, so excellent. This week's contender comes with a whopping 1.4 million views. And bear in mind, if there's one thing we know about financial advice, it's that popularity equals profitability. Judging by the overwhelmingly gushing comments, one even giving God's blessing, we've struck gold here. So let's dive into this revolutionary strategy. It all revolves around the impulse MACD, which is clearly superior to the regular MACD because it has the word impulse in it, and we all know how well acting on impulse works for us in trading. The video claims it's 3 times as profitable as the traditional MACD without telling you how profitable the traditional MACD is, and in general you'll notice the whole presentation is very light on actual data, which is rather ironic considering the channel name. The indicator looks like this. It's basically the MACD with some changes, entering trades when the signal line crosses the MACD line. The strategy recommends entering sells above the 0 line and buys below the 0 line, and only entering at the extreme peaks for the crosses. How extreme, I hear you ask? Well, that depends entirely on your imagination and your zoom level. If you zoom right in, they'll be much lower, and if you zoom way out, then the levels are going to be much higher. Nothing says reliable trading system quite like subjective visual interpretation, which is very strange for a claimed data trader. Oh, and let's not forget the 3-to-1 risk to reward ratio with stops at recent swing levels, unless those swings are too far away, in which case all of the trades are going to lose. Now, if you're anything like me, you'll be itching now to know the results because I've gone on long enough. So how bad was it? Well, drumroll please, it's not as catastrophically bad as the last two, so it's probably time to pop the champagne. We've gone from lose your shirt to lose your shirt slightly slower. In fact, if you squint hard enough, the results look alarmingly similar to random trading. But don't let that discourage you, because after all, who doesn't want their carefully crafted trading strategy to perform on par with a monkey throwing darts? And if your eyes were just drawn to the positive results in the 2024 test, well, I took the liberty of testing them over a 4-month period in 2019, pretty much at random, and surprise, surprise, they all became losers. So will this strategy blow your account in 2 weeks? No, it's far more considerate than that, I would say. It'll let you watch your money slowly trickle away over time. So in conclusion, is it better than the MACD as originally claimed? Well, no idea, because the original video didn't present any MACD data, so maybe. Is it profitable? This is the key question. Well, it's probably about as profitable as selling ice in the Arctic or something like that. In all honesty, you're better off keeping your money in the bank. And with that then, the score stands at good 0 and bad 4. If you've been brave enough to get this far, that means you're interested in seeing my code, so lucky you. What you're going to see here is my exploratory code. I've said in the first video of the series, if this actually shows signs of life, then I will go and clean it all up and make it efficient, but what I tend to do is spend just 5 or 6 minutes really writing some code to get a feel for the strategy. This one never got to the cleanup stage. So I've got the regular imports at the top here, so pandas, TA and stuff like that. Then here's really the pane that was actually trying to calculate the MACD impulse. In the end, what I did was hard code everything in, so it's very, very rough and ready, but deliberately so, and ended up getting through the MACD impulse here the same numbers as TradingView, which is just my aim. One of the many subjective things in the video is the swing points. I implemented the same function that I did for the first strategy in this series. That seemed to work pretty well. Then it was a matter of just adding the technicals, calculating up the trades, and then quickly checking the numbers against TradingView that they were all okay, and they seemed to be okay. One of the very subjective things in the video, as I pointed out, was the peaks that you have from the MACD. They depend entirely on the zoom level. My solution for this was simply to take approximately the same number of candles as were presented in that video and take the standard deviation and then go above around 1.5 times that. That seemed to work out quite well. Next was getting the numbers actually from the data frame. I'm not going to show you TradingView this time. You'll have to trust me. The numbers were exactly the same as TradingView, so I was pretty happy. Next step was then to actually print some of the trades out. And plotting things out from how the indicator should be set up, things seem to be okay regarding the swing points, the crosses and the trade entry. Next came the trade class with the risk to reward 3, including the spread as always as well. And then simply running a simulation, which I run actually on all of the combinations that I had of the major pairs. You've already seen the performance of the results, so I'm not going to take it through you again. What I did do, just show you here, though, is a typical example of what a positive one might look like. I think I ran the pound US dollar specifically here from 2023, July through till now, basically. And we had a 9% gain, but what you see as soon as you print out the cumulative gains is that before getting to there, we actually were 26% down in the account. And pretty much all of the charts were like this for all of the pairs over any period of time. In other words, completely random. Last but not least, and if you're wondering how the random trading was done, that's actually pretty simple. Inside the trade loop here, we pick out the buys and the sells. What I do then is take the number of those and literally pick out the same number of trades just randomly at any candle. And the result is pretty much the same as the indicator result. Make of that what you will. So that's how the coding was done. Any questions, let me know in the comments. Otherwise, I'll see you next week.